Yesterday, the Monetary Policy Committee sat and then they came out with very, very sweet information for all of us that affects each and every one of us directly or indirectly in the economy, the Nigerian economy. And I want to read what Nairametrics reported, very, very sweet site here that gives us up-to-date information about what's happening in our polity. And they said, in a decisive move to curb inflation and stabilize the economy, the Central Bank of Nigeria, normal CBN, has dramatically increased the monetary policy rate, normal MPR, to 400 or by 400 basis points, setting it up at an unprecedented 22.75. Anywhere where they say anything basis points, may they not confuse you, is interest rate they are talking about, right? So somebody says any basis points that anybody says divided by 100. If I say 400 basis points divided by 100, that's 4%. So they are trying to say 4%. But economists have a way of making something that's small look large. And they do it. My mom is an economist. So what are you talking about? If they say 40 basis points, they are talking about 0.4%. If they say 4 basis points, they're talking about 0.04%. So don't let's be confused. What they are saying here is that the last rate is now, the current rate is bigger than the last rate by 4% or 400 basis points. Let's continue. This adjustment makes a significant departure from the previous rate of 18.75%, maintained since the MPC and the Monetary Policy Committee's last convening in July 24th last year. Now, the decision announced by the CBN Governor, normal YC, also Olayemi Cardoso, propels the MPR to its highest point ever. Let's quickly scroll down to the part that's also sweet. And then the Apex Financial Institution has also escalated the CRR, normal cash reserve ratio, to 45%. Now, while all this is good and fine, for statements of what is happening in the economy and for economists to banter about whether this is the right decision or wrong decision, the other 200 and something million people that don't understand what's going on, this video is for you. Let's start from inflation. How does inflation come about? It is every CBN's responsibility to stabilize what is happening in their polity, right? And one of the activities that they do is to print notes so that everybody can have money, right? Sometimes to meet their obligations, the CBN prints more notes. And when they print more notes, what that means is that based off of the services that are the goods and services that are in the economy, we now have more money supply. I'll give you a very simple example. This is a very, very sweet bottle here, black and white. I love it so much. Monochrome, my best. Now, this bottle costs 20 naira. All of us in this office economy were 10. Only one person has 20 naira for this bottle. Everybody else has 15 naira. So if there's only one person that has 20 naira to buy a bottle, and there's only one 20 naira bottle to be bought, what that means is that demand and supply have met, or the supply has met the demand. So that one person that has the 20 naira will go and buy this bottle at 20 naira. Everybody's happy. Now, notes have been printed, money has entered into circulation. So now more people have more money. The person that originally had 20 naira has 25 naira now. And those that have 15 naira now have 20 naira. So now we have 10 people that can afford one bottle at 20 naira. If you are the supplier of this bottle, what will you do? You will increase it now because everybody is asking you for the bottle. So who will you sell to? Will you do first come first serve, or will you do you are fair so I like you, you are dark so I like you? So you step the price up by the additional money supply that is in the economy, which is that 5 naira. So this bottle will become 25 naira. And then what you will then see is that the person that can earn or that earns the 5 naira extra that now has 25 naira to buy this bottle will now come and buy this bottle at 25 naira. And again, demand and supply have now matched. So supply is now equal to demand. While everybody else, even with their 20 naira, you cannot still buy the bottle. And this will continue to happen until the bottle will turn to 30 naira, 40 naira, 50 naira. And then one day you wake up and say, but I used to buy this thing 20 naira, it's now 200 naira. That's exactly what happens with inflation. So now that we understand, how inflation works, we would agree that it's a bad thing because what I was buying for 20 naira, why am I buying it at 200 naira? So it's part of the job of the central bank of any country to help to regulate the rate at which the cost of goods and services increase in an economy. And there's a powerful tool that they use, which is the Monetary Policy Committee. Basically, a group of brain boxes who have very vast experience in economics headed by the central bank governor, in our own case, normal Mr. YC, normal Olayemi Cardoso. And what they sit, they now determine particular policies, that will help to curb inflation rates. And perhaps you may not know, but inflation rate right now is romancing 30%. That means that 30% of anything that you have, the value is depreciating. Anything that you have, the value is depreciating by 30%. So what they've done is they've increased what is known as the monetary policy rate. And this rate is basically interest rates that the banks keep money with the CBN at, and the banks lend between themselves. Let's take another very, very sweet example. Everybody has a bank account. Well, a lot of us have bank accounts, and we operate these bank accounts. We go there, put money, take money out. It's the exact same way that your bank operates a bank account with the CBN. They go there, put money, take money out. The monies that they put there is guided by CRR, what we read earlier. And that CRR has now been increased from what it was to 40%, saying that inside all the deposits that they've corrected me, that is 45%, even though what's even between 40 and what's even 6.5, it doesn't. Anyway, 45%, that's fine. Now, what that means is that if the banks take deposits of 100 million, what they are expected to have 45 million with the central bank, right? Now, the central bank is keeping this money for them at an interest rate. So that's fine. Give me your 45 million. I will give you 10% on 45 million. In this case, they will give 22.75% on 45 million. But for the sake of ease, let's use 10%. So what that means is that the bank already has this. So let's use the new rate, 10%, and they are getting that from CBN. So if me and you now go to the bank to borrow money, we won't get it at that 10%, we'll get it higher, because if the bank is already enjoying 10% from CBN and at a very relaxed rate, when they want to lend to each other, they lend at 10%. You that is now the third party to the transaction, you are going to get a higher percentage as a premium, for not taking, unless they can as well just send all their money, to CBN. So, but for them to be able to give you some of that money, you must be able to incentivize them. And the 5% or the 8%, whatever is on top it, is that incentive to give you that money. That's how it works. Now, because that interest rate has been raised, what that means is that the interest rate that you could have gotten money from the bank before has also been automatically raised. If you're a business person, you take 1 million every week at 10% that you can do your business, and then CBN raises monetary policy rate to 10%. The bank is now going to give you that your normal loan where you take at 12%. So where you were borrowing for 10%, normally you pay your 100K on top your 1 million. Now you have to pay 20K extra because now it's 12%. Because why are they giving you at 10% if they're already giving the CBN? It does not make any sense to their own bottom line. So what you would then see is that this 20% is too much. This additional 20K is too much for me. I can't feel well. So instead of borrowing 1 million, you borrow 500. Or you will not even borrow at all. Because why are they stressing your life, right? And because you did not borrow the 1 million, or you did not borrow as much as the 1 million, you now have less money to spend inside the economy. Now, this process is called tightening of money supply, because the money that you usually had at a lower interest rate, the interest rate is now high, so you couldn't feel well. You're not taking more money. You would rather take less or none, which means that your spending power has reduced. Now, let's go back to the first example. This bottle is still normal 25 naira, right? But now the richest person that was, maybe getting money at 10% is now, the interest rate is now 15%. So he couldn't feel well, he could not borrow more money, he couldn't get more money. So now what he has now is no longer 25 naira, it's now 20 naira. The same thing has happened to everybody else. Usually they will have 20 naira, but interest rates have gone up. So they have gone back to that, their 15 naira. As the seller of this bottle, what will you do? The person that normally buys from you comes and say, oh, but today now only 20 naira I get, and you were selling at 25 naira due to increased prices before. But you may not be able to lose that your one customer. So what will you do? You will drop the rate to his purchasing power. That process of dropping this 25 naira item to 20 naira, so that this other person that was usually buying from you but can no longer borrow because interest rates are high and now has only 20 naira, so that he will buy, make you fit breathe, make your inventory no go inventorize. You see what I did? I think so. I think you saw what I did there. Right. So what then happens is that prices in the economy drop, and then the reverse of inflation happens. So inflation also drops. This is the core principle behind why the CBN will raise interest rates, so that it can have a multiplier effect where money becomes too expensive to borrow, and then spending power is reduced, and then cost of goods and services in the economy go down to meet the spending power. While this stifles, normal economic processes, businesses, etc., and so forth, can no longer take loans at cheap rates or cheaper rates. Um, it is a very well-known procedure of curbing inflation. And this is the effect that it has on the spending power. We can also talk about the effect that it has on your investment power. So there are two broad-based kinds of investments. Investment that you keep and you rest. Investments that you do and you monitor. These ones are usually fixed deposits, treasury bills, normal bank deposits, certificate of deposit, all those other very, very sweet things. These ones are usually stocks, right? Now, stocks pay dividends. They have an infinite capacity to rise. So your profit is not capped. So it can rise as much as anything, but the risk is more because the way it did rise, now so if it fall. But for fixed deposits, your rate is already assured. You already know what you are going to earn at the end of the tenure. So your profit is capped. So your risk is less. Now imagine somebody comes up to you and say, for this almost riskless portfolio, I will give you 15%. And for this very risky portfolio where you might lose everything, I will also give you 15%. Which of the 15% you will take? You will definitely take this one, because why are you going to stress my life over 15% that I will still make here, right? So what would then happen would be that people in the stock market will exit their profits or their losses, as the case may be, from the stock market and go to this risk level, because this is 15%. This is so great. What's Treasury bill doing now? It's almost 20%. So if I know that my normal return in terms of yearly return that I make from the stock market is like 18%, why am I killing myself? Let me just go and buy a treasury bill or a government bond or whatever, fix the money there and rest, instead of always trying to find out, is this rising, is that rising, and taking more risk. So just like what we saw happen in February, and even in our Beige Club portfolio, where we took profits and then sent to a money market fund, people will leave the stock market and go to more fixed, this because they are earning higher. And then the prices of stocks based on demand and normal demand and supply will now fall, because you have more people trying to leave and less people trying to enter, right? So that's how it affects investment decisions. So you have more fixed deposit decisions and less decisions going into stock. But perhaps you have a mentor like Warren Buffett, who has said it's when everybody's running that you should come, and it's when everybody's coming that you should run. You might then be thinking of stocks as a very veritable means for investment. But don't do this without a financial advisor, unless to end in tears. In a nutshell, the CBN is not trying to make things very difficult for us. It's just a way to say inflation is going out of hand. Let's increase interest rates so that we can be able to stabilize, buying capacity in the economy for a time. And this time is not next month. It's not next 2 months. It can take up to 2 years in some cases. But eventually, it is expected that inflation rate will stabilize, and even the high interest rates are still attracting FPIs, because now my interest rate is so good, so FPI is a veritable opportunity for them as well. But it's not to suffer anybody. It's just to stabilize us so that the bottle that we're buying for 20 naira can feel well and buy it for 20 naira once again. So if this was helpful to you, let us know. Share this to anybody. Share any part of this that you thought was insightful to your finance community. We have our finance bestie by force, normal BBF, bestie by force. And person of Money Africa, we like what you guys are doing, and then we aspire to perspire and prospire to maguire what you guys are doing as well. Follow, like, share, and have fun in the comment sections. We are very, very excited to see conversations about finance.